You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, we've had a lot happen since we talked last week. We had a little election. Don't know if you've noticed, but that was yesterday. We are taping Options Playbook Radio on the 7th. It is a Wednesday after the election. The markets are closed. The Dow was up a mere 500 points on the close today. And we are still looking at earnings. But we had a very interesting trade last week in NVDA Corporation, and the way that it turned out, I think, is a great learning experience. And as always, on Options Playbook Radio, we want to just learn as opposed to try to do the strategies. It's all meant to be just a learning experience, and that's why we pick a lot of the trades that we do and try to mix and match a lot of the trades. And last week, we looked at doing a backspread on the bullish side. So we flipped a coin, decided we're going to be bullish in NVIDIA. NVIDIA stock symbol was NVDA. And the reason why I think it's an interesting trade or a learning trade is that it made a good move, but not a great move. It moved in our favor, and we had two different trades to look at. Both of the trades we did for the same net credit to the account. So what has happened? The underlying stock, NVIDIA Corporation, when we did the trade last week, the market was at 206. Let's call it 207. It's 206.97. We'll round up to 207. Okay. And we went and sold the 180 strike call on the November 16th expiration, and then bought two of the November 2005 calls on the same expiration. Now, that was just one of the trades, and that trade happened to contain an earnings report. So the earnings report has not happened, considering that today it is the 7th, but the trade did go on. So we had a little bit of a longer term trade, at least for Options Playbook Radio, and that trade contained earnings, and the width between the strikes was 25 points. Means we're looking for that type of a move, which was close to the expected move. So we wanted at least a 25-point move is what we were hoping for. Now, on the other backspread that we looked at, we said, well, let's look at one that does not contain earnings. And because it did not contain earnings, we did not have to go as wide to be able to get a spread. The implied volatilities were lower, which means the expected move is lower, which means that a backspread then, in order to receive a net credit, doesn't need to be quite as wide because the move over the time period expected is not as large. that makes sense. Both of these we did for a net credit of 20 cents, but on the November 9th expiration, which is going to be a few days from now, we were able to sell to open the 190 calls, and then we bought to open the 205 calls, the same calls as we did in the other strategy. Now, this trade is 15 points wide. We were able to get that done for a net credit of 20 cents, same net credit that we did on the November 16th expiration. Now, the requirement is larger, and as I referenced on the call last week, this is usually known as a pay later call, in that you're selling a credit spread to pay for an extra call. And so if you're dead wrong and the credit spread hurts you, that's how you're kind of paying later for that call, because we're putting it on for initial net credit to the account. So the width between the strikes in the 25-point one means that you would have 25 points times 100, or $2,500 for each trade that you did. In the nearer term one, it's 15 points. So you're talking about $1,500 and for the same type of trade, but you have a shorter time frame and you don't have the benefit of a big news event to make the stock take off. Well, the stock in general, after we put on the trade, went up, which is a good thing. And today, the underlying is trading at 213. Not quite 10 points. The stock was up $2.30 with the entire market. But in general, the stock basically had traded somewhere between 210 and 215 since we last talked. So it's been going in the right direction ever since we put on the trade. Now, so let's look at it. Let's look at the quotes. We talked a lot about the benefits of doing the backspread with the expiration that did not contain the earnings versus the expiration that did contain the earnings, and there were pluses and minuses for both ways to look at it. One of the biggest things about NVIDIA was the stock in general has been very volatile, and we were looking for a little bit of a dead cat bounce based off of a forecast from the midday market call and Michael Kahn, our chartered market technician. Okay, so now, if we look at the shorter term expiration, you're looking for a smaller move, and we got a smaller move. We could go in and put that trade on, and it is currently trading for a net credit to the account of $4.50. So the market has gone in the right direction. It didn't make quite as big of a move, but we are still looking at being able to get out of that trade for a net credit of $4.50. We would like it to continue on up. We're not quite out of the range. Like I said, we were looking for a 15-point move, and right now, I guess if I do the math real quickly, from where the strike price is at, we wanted to go 15 points. So we're at 2005 strike price, and you're at 213. So you're talking about $9 because it was 213.79. So we'll call it $9 move, and we need another 6-point move. But at this point in time, you can get this trade done for a net credit of $4.50 to the account. You can actually close out that position and have that type of gain. Now, on the one that contained earnings, the credit's not as big, but you're looking for a 25-point move. So to close that trade out, you're looking at a $3.05 net credit to the account. Now, remember, we put these trades on for net credits. The market has made a move to the upside, but the implied volatility has also increased on the November 16th expiration. So those two trades are going in the right direction. I personally would probably get out and not worry about the earnings. The big news that just happened right now drove the market higher, the entire market, and I would probably take advantage of that scenario and just close out the trades and move on overall. But very interesting trades. Okay, so let's look at another stock that was up big today, Home Depot. That was up $5.22. They are going to be announcing earnings on the 13th of November, which is a Tuesday. And let's do something a little bit simpler in that we are going to do a long put spread, and we're going to pay a lot of attention to the time premium that we bought versus the time premium that we're going to sell. And when I am looking at spreads around earnings, a lot of people like to just go further out of the money on a fairly expensive stock, right? $187 is where the stock is at. It actually closed the day at $187.23, up $5.22. So a fairly expensive stock, and you got earnings coming. Implied volatilities are up around 30%. They're not huge, but they are not astronomical either. The week before, we're looking at a 22% at the money implied volatility. So we're going to go and buy a just in the money option contract and then sell a just out of the money option contract. And part of the reason why I like to do this around earnings is it really takes the volatility out of it, and it puts in risk parameters for you already. So if we do this trade, it's going to be a 5-point wide trade, which is the maximum that that trade can be worth. So we already will have our risk parameters set in that we are going to be buying approximately the same amount of time as we are selling. And we have the November 16th expiration, so you can ride this in earnings if you would like to. And we're going to pay $2.35 at the midpoint, if we can fill it at the midpoint, for a 5-point wide spread. So our upside is going to be 5 minus the 235 or 265, and our downside is going to be that net debit that we paid, or $2.35. So I'd like to do spreads if I'm going to ride them in earnings. I want to go short term as I can. So they're going to announce on Tuesday. These options will expire on that Friday. And I've already got pretty decent risk parameters in place in that I know my max risk is $2.35, and I know my max upside is $2.65. So I don't mind just letting this ride. I know exactly where I'm at. Now I got to figure out the number of contracts that I want to do, and that's a totally speculative trade, so I'm not going to do too many of them. And I realize that the marketplace is expecting about a 7-point move. So it can easily move in either direction and cover the cost of this trade. So make it an instant winner and an instant loser on the gap open after earnings. But it's a very simple, straightforward trade. I just like to talk a little bit about why did we select the 190 strike long on the put side, and why are we selling the 185 strike on the put side? And it's because we're really straddling where the market is at. Our whole goal here is to spend a little bit less than the potential gain, and hence giving us a decent risk reward. If we are right, we make more than we lose. And over time, if you think about it, you do these trades, and let's say we're doing spreads on an expensive stock, or we could even just say the retail stocks, Home Depot, Lowe's, all of these type of companies. And we get those parameters. If we are right on our direction, just basically 50% of the time, and we have our risk managed, overall, we should be doing fairly good on our trades over one earnings period. So that's the concept. That's the theory. We'll let that be the end of this week's Options Playbook Radio. If you have a topic you'd like us to discuss on the show, or a question you'd like us to answer on the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you've sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.